Today we are going to talk about technical analysis. Technical analysis is the study of price charts. As traders, we use charts to understand what the market is trying to tell us. We are not guessing, we are looking for clues. There are four main things we want to understand when we look at a chart. First is trend. Trend tells us the direction of price. Is the market moving up, moving down, or moving sideways? Before we take a trade, we want to know the direction. Second is momentum. Momentum tells us the strength of the move. A stock or futures contract may be moving up, but is it moving with power or is it getting weak? Momentum helps us see that. Third is volume. Volume shows participation. It tells us how many buyers and sellers are involved. A move with strong volume is usually more important than a move with weak volume. Fourth is volatility. Volatility tells us the size of the movement. Is the market moving calmly or is it moving fast and wide? This helps us manage risk, stop losses, and profit targets. The most important lesson is this: indicators should confirm price action, not replace it. That means we should not blindly buy or sell just because one indicator gives a signal. We first look at price action. Then we use indicators to confirm what price is already showing us. The best trades usually happen when price action, trend, momentum, volume, and volatility all agree. Now, let's talk about the lesson goal. By the end of this lesson, students should understand how technical analysis helps traders make probability-based decisions. That is very important. Technical analysis does not guarantee that every trade will win. Instead, it helps us improve our odds by reading the chart correctly. The first goal is to understand the purpose of technical analysis. We use technical analysis to study price movement, find trends, and identify possible entry and exit areas. The second goal is to learn how to use indicators to confirm trend and momentum. Indicators should help us see whether the market is strong, weak, trending, or slowing down. The third goal is to learn how to read volume and volatility before taking risk. Volume tells us if traders are participating in the move. Volatility tells us how big and fast the price movement is. The fourth goal is to avoid common beginner mistakes. A lot of new traders make the mistake of using too many indicators, or they enter into trades only because one indicator gives a signal. The main lesson here is this: technical analysis is not about finding one perfect indicator. There is no magic indicator that works all the time. Good trading comes from combining different pieces of information: price action, trend, momentum, volume, volatility, and risk. When all of these things come together, we can make a clearer and more confident trading decision. Now, let's define technical analysis. Technical analysis is the study of price, volume, patterns, and indicators. The purpose is to help traders understand what is happening in the market right now. There are three important parts on this slide. The first one is price action. Price action shows us what buyers and sellers are doing. Are buyers in control? Are sellers in control? Is price breaking out, pulling back, or moving sideways? Price action is the most important part because it shows the real movement of the market. The second part is indicators. Indicators are tools that calculate information from price, trend, momentum, or volatility. Examples include moving averages, RSI, MACD, VWAP, Bollinger Bands, and TTM squeeze. But remember, indicators should not be used by themselves. They are there to confirm what price is already showing us. The third part is volume. Volume shows how much participation is behind the move. A price move with strong volume usually has more meaning than a price move with weak volume. Volume helps us see whether traders are truly interested in that move. The key point is this: technical analysis helps traders understand probabilities. It does not predict the future perfectly. Our goal is not to be right on every trade. Our goal is to improve timing, manage risk, and choose better trades. So always remember, price comes first, indicators come second. We read the chart first, then we use indicators as confirmation. Now let's talk about one of the most important rules in technical analysis. Price comes first. Before we add indicators to a chart, we need to understand the basic structure of price. Price can usually be in one of three conditions. The first condition is an uptrend. An uptrend means price is making higher highs and higher lows. This tells us buyers are in control and the market is moving upward. The second condition is a downtrend. A downtrend means price is making lower highs and lower lows. This tells us sellers are in control and the market is moving downward. The third condition is sideways movement. This means price is trapped between support and resistance. The market is not clearly trending up or down. It is chopping back and forth. Before taking a trade, we should always ask, is price trending? Is price chopping sideways? Is price breaking out? Or is price reversing? This is important because an indicator signal is much stronger when it agrees with price structure. For example, if price is in an uptrend and an indicator gives a buy signal, that signal has more strength. But if price is stuck sideways and an indicator gives a buy signal, that trade may be risky because the market has no clear direction. The big lesson here is, do not let an indicator convince you to ignore support, resistance, and trend. Price action gives us the story. Indicators only help confirm the story. Now, let's talk about moving averages. A moving average is one of the most common tools in technical analysis. It smooths out price movement so we can see the trend more clearly. Instead of looking at every small candle movement, the moving average helps us answer one simple question. Is price generally moving up, moving down, or going sideways? On this slide, we have a few common moving averages. The 9 EMA is often used for fast momentum. It reacts quickly to price movement, so short-term traders may use it to see quick changes. The 21 EMA is often used for the short-term trend. It helps traders see whether the current move still has strength. The 34 EMA can be used as a trend filter. For example, some traders only look for long trades when price is above the 34 EMA, and only look for short trades when price is below it. The 50 SMA is often used for the medium-term trend. It is slower than the shorter EMAs and gives a bigger picture view. The 200 SMA is used for the long-term trend. Many traders watch this level because it can act like major support or resistance. Here is the basic idea. When price is above the moving average, we usually have a bullish bias. When price is below the moving average, we usually have a bearish bias. When the moving average is rising, the trend may be strengthening. When the moving average is falling, the trend may be weakening. But we must remember the teaching point. Moving averages work best when the market is trending. They can give false signals when the market is choppy or sideways. So before using a moving average signal, always look at price structure first. Ask yourself, is the market trending or is it stuck sideways? A moving average should help confirm the trend, not replace your chart reading. Now, let's talk about VWAP. VWAP stands for Volume Weighted Average Price. This indicator is very popular with day traders because it helps show who may have control during the trading day, buyers or sellers. When price is above VWAP, buyers may have intraday control. This means the average trader who bought during the day may be in a better position, and the market may have a bullish bias. When price is below VWAP, sellers may have intraday control. This means price is trading below the average volume-weighted price, and the market may have a bearish bias. VWAP can also act like support or resistance. For XLL, a VWAP bounce or VWAP reclaim. If price moves up to VWAP and gets rejected, that can show sellers are defending that area. That is called a VWAP rejection. Day traders use VWAP to judge intraday control, but we must remember one important thing. VWAP is more useful for intraday trading than long-term investing. The main lesson is this. VWAP helps us understand where price is trading compared to the average price paid during the day. If price is above VWAP, we look for buyer strength. If price is below VWAP, we look for seller strength. But just like every indicator, VWAP should be used with price action, volume, support, resistance, and trend. Example, if price pulls back to VWAP and bounces, that can show buyers are stepping in again. Now let's talk about RSI. RSI stands for Relative Strength Index. RSI is a momentum indicator. It helps us understand whether price has strong momentum, weak momentum, or is somewhere in the middle. On this slide, we have 3 important RSI areas. When RSI is above 70, it can mean the stock has strong momentum, or it may be overbought. But this is very important. Just because RSI is above 70 does not automatically mean we should sell. A strong stock can stay above 70 for a long time, especially during a powerful uptrend. When RSI is around 50, that is the balance area. It means momentum is not extremely strong or extremely weak. Traders often watch the 50 level to see if momentum is shifting from bullish to bearish, or bearish to bullish. When RSI is below 30, it can mean weak momentum, or it may be oversold. But again, we must be careful. Just because RSI is below 30 does not automatically mean we should buy. A weak stock can stay below 30 for a long time, especially during a strong downtrend. The big mistake beginners make is buying only because RSI is low, or selling only because RSI is high. RSI works best when we combine it with other information. We should ask, what is the trend? Is price near support or resistance? Is there a candle confirmation? Is volume supporting the move? The teaching point is this. RSI is strongest when it is combined with trend, support, resistance, and candle confirmation. So RSI should not be used alone. It should help confirm what price action is already telling us. Now, let's talk about MACD. MACD stands for Moving Average Convergence Divergence. MACD is a momentum indicator. It helps traders see when momentum may be shifting from bullish to bearish, or from bearish to bullish. There are three main parts of MACD. The first part is the MACD line. The MACD line measures the direction of momentum. When the MACD line is moving higher, momentum may be getting stronger. When it is moving lower, momentum may be getting weaker. The second part is the signal line. The signal line is used to help confirm crossovers. Traders often watch when the MACD line crosses above or below the signal line. When the MACD line crosses above the signal line, it may show bullish momentum starting. When the MACD line crosses below the signal line, it may show bearish momentum starting. The third part is the histogram. The histogram shows whether momentum is increasing or fading. If the histogram bars are getting bigger, momentum may be increasing. If the histogram bars are getting smaller, momentum may be slowing down. But we must remember something very important. MACD works better in trending markets. When the market is choppy or moving sideways, MACD can give false signals and whipsaws. That means it may show a buy signal, then quickly show a sell signal, and confuse the trader. So before using MACD, always ask, is the market trending? Is price above or below an important moving average? Is price near support or resistance? Does volume support the move? The teaching point is this. MACD is useful for spotting momentum shifts, but it should be used with trend, price action, and market structure. MACD should confirm the trade idea, not be the only reason for taking the trade. Now, let's talk about TTM squeeze. TTM squeeze is an indicator that helps us identify volatility compression before expansion. That means the market may be getting quiet first, and then later, it may make a bigger move. There are two main ideas on this slide. The first one is squeeze on. When the squeeze is on, price is compressing, the candles may become smaller, and the market may look like it is building energy. This is like a spring being pushed down. The longer it compresses, the more traders start watching for a possible breakout. The second one is squeeze off. When the squeeze turns off, it may mean the compression is ending and a larger move may be starting, but this is very important. The TTM squeeze does not tell us the direction by itself. It tells us that energy may be building, but it does not automatically tell us whether price will break up or break down. That is why direction should be confirmed by other things, such as trend, candle structure, support and resistance, and momentum. For example, if price is above support, the trend is up and momentum is improving, then a squeeze release may have a better chance of moving higher. But if price is below resistance, the trend is down and momentum is weak, then a squeeze release may have a better chance of moving lower. The beginner mistake is assuming every squeeze will lead to a clean breakout. That is not true. Sometimes the squeeze releases and price fails. Sometimes it breaks out for a short time and then reverses. The teaching point is this. TTM squeeze helps us recognize when the market may be preparing for a bigger move, but price action and trend must help us decide the direction. Now, let's talk about volume confirmation. Volume tells us how much participation is behind a move. In simple words, volume helps us answer this question. Are traders really supporting this move, or is price moving with weak participation? On this slide, we have two examples. The first one is a high volume breakout. A high volume breakout is usually stronger because more traders are participating. If price breaks above resistance and volume increases, that can show strong demand. Buyers are stepping in, and the move may have more strength behind it. The second one is a low volume breakout. A low volume breakout is usually weaker because participation may be limited. Price may move above a level, but if volume is low, we have to be careful. The breakout may fail because there may not be enough buyers supporting the move. Volume can also give us warnings. Heavy buying volume can show strong demand. Heavy selling volume can be a warning sign that sellers are taking control. Volume spikes after a long move can sometimes show exhaustion. This means a lot of traders may be rushing in late, and the move may be getting tired. The main lesson is this. Price movement with strong volume is usually more meaningful than price movement with weak volume. But remember, volume should still be used with price action. A good breakout is not just price moving above resistance. A stronger breakout happens when price breaks the level, volume increases, and the candle closes with strength. So when we look at volume, we are asking, is this move supported by real participation? If the answer is yes, the signal becomes stronger. Now let's talk about ATR and volatility. ATR stands for average true range. ATR tells us how much price usually moves over a certain period of time. In simple words, it helps us understand whether the market is moving calmly or moving aggressively. This is very important because volatility affects our risk. There are three main ways traders can use ATR. The first one is stop loss. If volatility is high, price may move up and down very quickly. That means a stop loss that is too tight may get hit too easily. ATR can help us give the trade enough room. The second one is targets. ATR can help us plan more realistic profit targets. For example, if a stock usually moves $1 in a day, it may not be realistic to expect a $5 move without a special reason like news, earnings, or a major breakout. The third one is position size. When volatility is higher, risk is also higher. Larger candles can mean larger losses if the trade goes against us. That is why higher volatility may require a smaller position size. Now, look at the key points. If ATR is rising fast, volatility is expanding. This means the market is moving more aggressively. Large candles increase risk because stop losses may need to be farther away. When volatility rises, risk rises too. The main lesson is this: ATR helps connect technical analysis to risk management. A good trader does not only ask, where should I enter? A good trader also asks, where is my stop loss? Is my target realistic? How much size should I use? Is the market too volatile for my risk level? ATR helps us answer those questions before we take the trade. Now, let's talk about combining indicators with price action. This is where trading starts to become more complete. A lot of beginners look for one perfect indicator. They may say RSI gave a signal, or MACD crossed, or price touched a moving average. But one signal alone is usually weak. A stronger setup happens when multiple pieces of information agree with each other. On this slide, we have 5 important parts. The first part is trend. For example, price is above the 34 EMA. That tells us the market may have a bullish bias. The second part is level. Price pulls back to support. This gives us an area where buyers may step in. The third part is momentum. RSI holds above 50. That tells us momentum is still staying on the bullish side. The fourth part is volume. Buying volume rises. That shows more traders are participating in the move. The fifth part is risk. The stop loss is clearly defined. This is very important because every trade must have a plan before entry. Now, when all of these line up together, the trade idea becomes stronger. We have trend, support, momentum, volume, and risk all working together. The main lesson is this: do not enter a trade just because one indicator flashes. Instead, ask yourself, does the trend agree? Is price near a good level? Is momentum supporting the move? Is volume confirming the move? Is my risk clearly defined? When these pieces line up, we have a higher probability setup. It still does not guarantee a winning trade, but it gives us a better trading decision. Now, let's talk about the difference between trend following and reversal trading. These are 2 different styles of trading, and students should understand the difference before choosing a strategy. First, let's look at trend following. Trend following means we are trading in the same direction as the current trend. If the market is in an uptrend, we look for buying opportunities, especially on pullbacks. If the market is in a downtrend, we look for shorting opportunities, especially when price bounces into resistance. Trend traders often use moving averages as filters. For example, if price is above a moving average, they may focus more on long trades. If price is below a moving average, they may focus more on short trades. The main idea is simple. We are not trying to fight the market. We are trying to follow the direction that price is already moving. Now, let's look at reversal trading. Reversal trading means we are trying to catch a change in direction. For example, a trader may look for a double bottom, a double top, RSI divergence, or a break of a trend line. A double bottom may show that sellers are losing control and buyers are starting to step in. A double top may show that buyers are losing control and sellers are starting to step in. RSI divergence can show that momentum is weakening even though price is still moving in the same direction. A break of a trend line may show that the old trend is starting to fail. But reversal trading is harder because timing is very important. Sometimes traders think a reversal is starting, but price only pulls back and then continues in the same trend. That is why reversal trading requires stronger discipline and better risk control. The teaching point is this: trend trading is usually easier for beginners because we are trading with the direction of the market. Reversal trading can work, but it requires more experience, patience, timing, and risk management. So before taking a trade, always ask, am I trading with the trend, or am I trying to catch a reversal? Once you know that, your entry, stop loss, and profit target will become much clearer. Now, let's finish with a technical analysis checklist. Before entering a trade, we should not rush. We should go through a simple checklist to make sure we are making a clear decision. The first question is, what is the trend? Is price moving up, moving down, or sideways? This helps us understand the bigger direction of the market. Next, is price above or below key moving averages? If price is above important moving averages, buyers may have more control. If price is below them, sellers may have more control. Then we ask, is price above or below VWAP? For intraday trading, VWAP helps us see who may have control during the day. Above VWAP may show buyer strength. Below VWAP may show seller strength. Next, is momentum strong or weak? We can use indicators like RSI, a MACD, or TTM histogram to see if momentum is improving or fading. Then, is volume confirming the move? A move with strong volume is usually more meaningful than a move with weak volume. Now we look at volatility. Is volatility normal or too high? If volatility is too high, the trade may be riskier. Stops may need to be wider, and position size may need to be smaller. Next, where are support and resistance? Before entering a trade, we need to know the important levels on the chart. We do not want to buy directly into resistance or short directly into support. Then, where is my stop loss? Every trade needs a risk plan before entry. If we do not know where we are wrong, we should not take the trade. Next, is this trade with the trend or against the trend? Trading with the trend is usually easier. Trading against the trend requires better timing and stronger confirmation. Finally, am I using indicators as confirmation, not prediction? This is one of the most important lessons. Indicators should support what price action is already showing us. They should not be the only reason we enter a trade. So before every trade, slow down and ask these questions. A good trader does not just look for signals. A good trader builds a complete decision using trend, price action, momentum, volume, volatility, support, resistance, and risk. Now, let's finish with a simple teaching summary. This is what I want you to remember from today's lesson. Technical analysis is the study of price, volume, patterns, and indicators. It helps us understand what is happening on the chart and make better probability-based decisions. The most important rule is price action comes first. Before we look at indicators, we must understand what price is doing. Is price trending up? Is it trending down? Is it moving sideways? Is it breaking out or reversing? Indicators should be used to confirm price action, not replace it. Moving averages help us identify the trend. VWAP helps us understand intraday buyer or seller control. RSI and MACD help us measure momentum. TTM squeeze helps us recognize volatility compression, which means the market may be preparing for a bigger move. Volume helps us confirm whether the move is strong or weak. ATR helps us manage volatility and risk, including stop losses, profit targets, and position size. The biggest mistake beginners make is thinking one indicator can tell them exactly what to do. That is not how good trading works. Good trading comes from combining different pieces of information: price action, trend, momentum, volume, volatility, support, resistance, and risk. So the best closing line for this lesson is, use indicators as tools, not magic signals. Indicators are there to help us make better decisions, but the final decision should always come from reading the full chart.